In America, Silvergate, Silicon Valley Bank, and Signature Bank have failed. First Republic Bank has suffered a run, leading to liquidity support from other lenders. In Europe, Switzerland's Credit Suisse has fallen into the arms of bitter rival UBS, and although that deal, plus regulatory intervention in the US, looks to have calmed markets and depositors, investors could be forgiven for thinking, what's coming next? Once confidence ebbs, it can be hard to get it back, but anyone with cash on deposit in a UK bank or owns shares in the listed lenders might like to consider the following points. Silvergate, Silicon Valley, Signature, and Credit Suisse were all badly run. They took too much risk, and in the case of the Americans, were too exposed to one particular area, cryptocurrencies, venture capital, and commercial real estate, respectively. Second, the Americans had grown their asset bases rapidly, especially in the last 2 to 3 years, whereas the UK-listed banks and their European counterparts have been taking less risk and shrinking their balance sheets and asset bases. Even Credit Suisse got around to it, albeit a bit too late. Third, under Donald Trump, the US launched a fresh round of deregulation in 2018, raising the asset threshold for European-style regulation to $250 billion in assets from $50 billion. That enables smaller banks and regionals like SVB, Signature, and First Republic to take more risk. Europe, including the UK, has tighter regulation and thus runs more regular, rigorous stress tests on any banks with more than €30 billion worth of assets. Fourthly, all of the so-called globally systemic important banks, or GSIBs, in the UK and Europe meet all of the regulators' capital adequacy and liquidity tests and have far more capital and far fewer assets than they did in 2007 before the Great Financial Crisis. They also have to market any losses on assets, so there are no so-called hidden losses of the kind that frightened SVB's depositors and started their run on the bank. Fifthly, European and UK banks did not over-distribute cash back to shareholders in 2021-22, unlike the big US banks. Yes, they ran buybacks and paid dividends, but nothing like to the degree the Americans did. And note that the big US megabanks stopped their buybacks in the second half of 2022, perhaps realising they'd slightly overdone it. And sixthly and finally, from a stock market point of view, the big 5 FTSE 100 banks all trade at or below net asset or book value per share, to at least partially price in further loan losses and economic bad news. Bank of America, Goldman Sachs, JP Morgan Chase, Morgan Stanley and Wells Fargo all trade at a premium. The only US megabank to trade at a discount, intriguingly, is Citigroup. So in sum, in crude, very general terms, US banks equals more risk, less regulation, especially for smaller regional banks and higher valuations. The UK and Europe equal less risk, higher regulation and lower valuations. And don't forget, any deposits that you have with a UK bank are covered by the Financial Services Compensation Scheme up to £85,000 at each qualifying bank or institution. So if you are worried for any reason, you can actually spread your capital around in case anything untoward happens. And in fairness, it still might if things get out of hand. Credit Suisse had passed the regulatory tests, but still fell into the arms of UBS anyway because it was badly run and because customers and clients lost confidence and yanked their money out. Total customer deposits had dropped to 233 billion Swiss francs at the end of 2022. And that was down from a peak in early 2021 of just under 400 billion. So there had been money pulled out. Investors will also be left wondering whether the wobble has any wider impact upon the global economy, monetary policy, and even inflation. If banks start to take less risk and lend less, well, that can impact growth. And if central banks respond by pivoting to rate cuts or even more quantitative easing, heaven forbid, well, that could risk inflation, which is still, let's face it, above target. So investors will have to look at all of these issues, and they have 3 guides to help them judge whether maybe recession, maybe more wobbles, and maybe a return to looser monetary policy and even more money printing are on the way, or whether, on the plus side, the UBS Credit Suisse deal, regulatory and central bank responses are going to be enough to stem the banking panic and hold up the economy and put a lid on inflation for good measure. The first indicator is the so-called yield curve. Now, usually, 10-year government debt offers a premium yield to 2-year paper to compensate holders for the risks presented by the extra time span and therefore the greater chance for something going wrong, such as inflation, interest rate changes, or even default in extreme cases. But sometimes 10-year paper trades at a lower yield than 2-year paper, and this is seen as a recession signal because it means markets are pricing in future interest rate cuts in response to an expected downturn or economic recession. Now, until a few days ago, the 2s-10s curve on US Treasuries was at its most inverted 2-year paper yielding more than 10-year since the double-dip recession of the early 1980s. It's still inverted now, and therefore bond markets may seem to be gearing themselves up for a downturn or even a recession. If they're right, well, that could prompt central banks to stop tightening policy and start loosening it. If they fail to convince markets they've got the right tools for both economic stability and financial market stability. In the UK, by the way, the 2s-10s curve on gilts is almost flat. They yield almost the same after brief periods of inversion in autumn 2022 and then early 2023. The second indicator is the yield on 2-year government debt. Now, following the yield on just 2-year government debt and not 10-year can be useful in another way. And by the way, you can follow all of these on the internet for free, 2, 10, UK and US yields, just with a little bit of searching. Usually, for whatever reason, the yield on the 2-year gilt in the UK and the 2-year Treasury in the US has moved 6 to 9 months before the Bank of England and the US Federal Reserve have changed policy. Maybe markets are just smarter than central banks, I don't know. But as I sit here, the UK 2-year yield is 3.44%, lower than the Bank of England base rate, and the 2-year Treasury is 4.13%, also lower than the Fed funds rate. If 2-year yields keep going lower, then the market may be saying a recession's coming and policy's already too tight, although yields are likely to be volatile as markets try and second guess what central banks are going to do. The third indicator is the gold price, which had another go at reaching $2,000 an ounce as Credit Suisse crumbled. The precious metal is often described as a hedge against inflation because it did so well in the 1970s when inflation galloped away, but it may be more accurate to say it's a hedge against policy error and central banks and governments losing control. That's why it did so well in the 1970s, but also in the early 2000s when inflation wasn't an issue but the credit crisis was. If gold breaks above $2,000 an ounce and motors on, we may indeed be getting a big policy pivot towards loosening rates, but not because inflation's cooling, but because the economy's slumping and central banks have unwittingly over-tightened. A pivot to cutting rates and even a relaunch of QE could be seen as admission of policy error and that trouble may lie ahead. A weak gold price, by contrast, could imply that all is indeed still in hand and well, or that further policy solutions are at hand. I hope you found that useful. I hope that your families and friends are all well, and I look forward to speaking to you next time.